All right, we're briefly back to the old setup. And it's not because of the title of this video. As you saw in the last few videos, the camera quality wasn't so good. But enough of that. We still got the microphone. It's going to be coming back once I've got an adapter for the iPhone. The iPhone has a very good camera. No real reason to get another camera. So trying to keep this setup simple. Anyways, let's get into the content of the video. As you can see by the title, I am having to make some serious moves. We started this week well, shorts were printing, things were going in our favor, and then all of a sudden, the market was moving very dramatically right under our nose. And I still have my fundamental case. I'm gonna get into broader analysis in a second. I'm just sharing what I'm thinking from a portfolio management perspective. It's been a rough year for us, for me. Our firm has suffered losses after a stellar last year, absolutely stellar last year. And it's just totally unfortunate. You know, we're doing the best work we possibly can do. I'm not trying to come onto these videos, give you some sort of emotional response, and I'm totally acknowledging recency biases, all these kinds of things. I'm very in tune and aware of those forces. However, the market can remain irrational longer than we can remain solvent. And while we're not necessarily in a solvency crisis yet, we are heavily in double-digit losses this year, and that just can't continue. So I don't know how long this tape is going to continue. I've already sold a bunch of stocks today closed a bunch of shorts today after hours, closed some shorts yesterday after hours, sold some options today. Going to sell a lot more options tomorrow. That's just what I got to do. I got to clean up the position. You know, I just got to clean up the portfolio, acknowledge that I have been wrong here, and get ready to pick ourselves up for the next round. Because while our performance hasn't been so good, in my opinion, these fundamentals are absolutely phenomenal, particularly in terms of the kind of stock responses they're generating. Intel just suffered its worst quarterly loss ever. This is arguably the biggest slowdown in chips ever. And now I get it. Chips are a long-term story. That's all great. But the stocks, the biggest players in this area, not Intel in terms of, I'm not talking about Intel here. Very cheap. It's like almost like it's backwards. The companies making the most money and have the best, vertical integration have the lowest multiples. And those that entirely outsource the production, NVIDIA, have tremendous multiples. So it's a very strange time in positioning in this market. We're experiencing very dramatic revenue slowdowns, very dramatic earnings declines. I mean, Meta is up 15%. And their earnings are down 19% year on year. I don't know how that gets reconciled. Microsoft is, I get it, they're making more money than they were in Q1 last year. That is a fact, that's true. Their earnings has actually gone up. But in order to command the kind of multiple you're getting, not only a premium to the market, but 30 multiple, let's not forget, the S&P 500 currently has an above average multiple. That means we need to have above average growth. And that is not the case. It's simply not the case. So the fundamentals, the factors, I think they warrant lower stock prices. Not a Microsoft that is currently priced where it was in January 2021 or 2020. Just after the biggest speculative bubble, arguably of all time, although debatable based on the internet bubble because these companies actually do produce revenue, actually do produce earnings. Very different environment, but we had cryptocurrencies. We had just aggressive moves in speculative assets objectively. So that is an overview of things. I think the environment is deteriorating. I mean, GDP came in well below forecasts. In any other environment, in any other day, that would have had an impact on the market. Quite a dramatic one. if the market was expecting 1.8% GDP and we got 1.1% GDP. Why it's not doing it this time when the Fed is simultaneously hiking rates for the first time, we're getting contracting GDP and a Fed hiking rates, I don't know. It's mind-boggling. It's unprecedented in history, particularly the stock performance in that economic environment that is already unprecedented in history. But like I said, what am I? I'm just a dude. I'm 23 years old. I'm here talking on a camera. I'm just me. I can't change the market, and I have to admit defeat here. You know, it was great celebrating victories all last year. We were playing the fundamentals and we were winning. But things changed this year so far. I don't think they're going to change forever, but I can't take more losses now. I have to live to fight another day. That's just the bottom line. Sometimes you just have to live to fight another day. And that's the kind of position we're in. So I'm here capitulating. It's not fun. Hasn't been a fun year this year, but this isn't over. We're going to be making videos every single day, and we're here to fight another day at the end of the day. So fundamentals, I think, are weak. I'm going to listen to that Amazon call. I listened to the Meta call. I'm just not impressed. I'm sorry. I'm just not impressed. I'm not compelled to buy these stocks. Like, it would be one thing if if it was like 2012, but it's not. It's 2023. I don't know who is left to sign up for Instagram that hasn't already signed up, or, you know, you get what I'm saying here? So they're, in my opinion, suffering structural headwinds. They said for themselves, Reels monetize less efficiently, but they're trying to expand Reels. So that was part of the reason why they experienced a decline in earnings, because they're trying to optimize for something that produces less money. So why the stock is up 15% and higher than where it was this time last year before this earnings decline was even forecast, I don't know. But again, I reiterate, this market is not being very fundamental based. These companies are trading at close to, if not at, all-time historical high multiples for the top 10 companies. That's, the top 10 earnings multiples for the top 10 companies. If you just say, instead of S&P 500 multiple, the top 10 companies multiple, this has got to be one of the highest ever. And that would make sense if interest rates were zero and these companies were growing double digits like they were in 2021. That's simply not the case now. It's a very different picture. Very, very different picture. They're at historical high earnings multiples and historical low growth rates. I simply don't know how to reconcile this. This is like beyond the stock market. The Fed isn't printing money. They're deleting money. So I don't know where the extra pie is going to come from. But I've shared enough for today. That's today's video. I hope you enjoyed it. Until next time, peace out.